In this Taxlayer Pro presentation, we'll go over the Tax Cuts and Jobs Act and its effects on individual tax returns. This is part one of a two-part presentation. Remember, or imagine if you're too young to remember, when a new Ford Mustang cost $74.52 and a gallon of gas was 89 cents. When the largest nuclear power plant disaster in history occurred at Chernobyl. When you could buy a Nintendo Entertainment System for $89.99 and a Chuck Norris action figure for $12.99. The year was 1986, and it was the last time a restructuring of the United States tax code was undertaken. In 1986, there was no electronic filing of tax returns, no software commercially sold to prepare income tax returns. No Taxlayer. From the Taxlayer Pro website, we read the company's venture into software development began in 1989. A new tax software enabled local Rhodes-Murphy tax preparation offices here in Augusta, Georgia, to complete tax returns on the computer instead of by hand, a revolutionary step that improved efficiency. The software increased the number of returns completed and raised the market price for services. When the software development was completed in 1991, it was named Taxlayer Pro after the original email address of Jimmy Rhodes, who was the company president at that time. So why are we here? Well, this is the 2017 1040 as we know it now. These are the items that will change as a result of the Tax Cuts and Jobs Act for 2018. Dependents may move to other forms. Starting in 2019, many of the lines will be eliminated or changed. There'll be a new qualified business income deduction. Some of the lines on page 2 will be eliminated through the year 2026. Some of the lines in the other taxes section will be eliminated starting in 2019. So in this presentation, we'll begin with an overview. We'll review generally the tax code provisions affected by the Tax Cuts and Jobs Act, or the TCJA, that will impact individuals. And take note, provisions regarding business returns and businesses, Schedules C, E, and F, will be done at a future session. And finally, how the changes will impact you by comparing your 2017 tax return data to the TCJA. First, let's begin with an overview. A tax loophole is something that benefits the other guy. If it benefits you, it's tax reform. And that's a quote from Russell Long, United States Senator from Louisiana, who lived from 1918 to 2013. The Tax Cuts and Jobs Act of 2017 was signed into law on December 22, 2017. Most provisions became effective January the 1st, 2018. Generally, many, not all provisions impacting individuals will expire by the year 2026. And in general, most sections impacting corporations do not expire and are permanent changes. Some provisions were retroactive back to September the 24th, 2017. Some don't go into effect until January the 1st, 2019. The Congressional Budget Office estimates the tax cuts will increase the federal deficit by $1.455 billion over the next 10 years. Net federal revenue will decrease by $1.649 billion. Net federal outlays will decrease by $194 billion. The Joint Committee on Taxation estimates that the cost of the tax cuts will be offset by the growth of $385 billion, and the net deficit increase will be $1.070 billion. The winners of the Tax Cuts and Jobs Act: taxpayers who are more likely to benefit are corporations, higher income bracket taxpayers, standard deduction filers who have no dependents, taxpayers with high charitable deductions, and taxpayers with qualified business income. This includes most pass-through business owners and individuals who have a Schedule C income. The losers, the taxpayers less likely to benefit, are itemized deduction filers from states with higher income tax rates and or high property taxes. Itemized deduction filers with large mortgages, second homes, are less likely to benefit, and taxpayers who have an ITIN. As far as winners versus losers, the impact on most taxpayers will depend on many factors. The higher your tax bracket, the more likely you are to benefit. The lower your tax bracket, the less likely you are to benefit. Whether you take the standard deduction or itemize on your return will have an impact on your tax return. Whether you have business income, such as pass-through or Schedule C, E, or F, will have an impact on your tax return. And the number of dependents on your return, their type, age, and status, whether or not they have an ITIN or a Social Security number. And some projections regarding the Tax Cuts and Jobs Act. Approximately 80% of taxpayers should realize some decrease in their overall tax bill for 2018. 7 to 10% will see some increase in their taxes for 2018. The remaining taxpayers should see little or no change in their tax bill, and this is according to the Urban Brookings Tax Policy Center. The average decrease in 2018 for all taxpayers is expected to be about $1,600, increasing after-tax income about 2.2%. The highest 1%, above $733,000, is expected to have average decrease of approximately 3.4% of their income tax bill. The highest 0.1% of wage earners, earning above $3.4 million, is expected to have an average decrease of approximately 2.7% of their income tax. The remaining taxpayers are expected to have an average decrease of about 1.6% of their income tax. Here's a graphical illustration of some changes that will occur because of the Tax Cuts and Jobs Act. Taxpayers in the bottom quintile, or those with incomes less than $25,000, will see an average tax cut of about $60. Taxpayers in the middle income quintile, those with income between about $49,000 and $86,000, would receive an average tax cut of about $900. Taxpayers in what we call the 95th to 99th income percentiles, or those with income between about $308,000 and $733,000, will benefit the most as a share of after-tax income, with an average tax cut of about $13,500, or 4.1% of after-tax income. And taxpayers in the top 1% of the income distribution, those with income more than $733,000, would receive an average cut of about $51,000. Most benefits for the individual taxpayer will come in the earlier years of the bill, of the Tax Cuts and Jobs Act. Benefits individuals receive will erode each year through the year 2026. By 2026, the last year the provisions impacting individuals are in effect, the average tax cut will drop to about $160, or 10% of what individuals should receive in the year 2018. By 2026, a majority of taxpayers will be paying the same amount or more in taxes than if the law had never been changed. Major changes for individuals as a result of the Tax Cuts and Jobs Act are a chained consumer price index. We'll talk about this in just a moment. New tax brackets and rates for individual taxpayers, the elimination of personal exemptions, increased standard deduction, changes to itemized deductions, changes to the child tax credit, and modified other deductions and credits, and the individual mandate penalty will change, and Another major change, raising the AMT exemption and the phase-out, the alternative minimum tax exemption. Let's take a closer look at the impact on individuals. The new legislation permanently changes the indexing method for provisions in the tax code for tax years starting after December 31st, 2018. The changed Consumer Price Index is an adjustment that accounts for the fact that consumers tend to shift their purchasing behavior as the relative prices of things change. In other words, consumers will choose lesser priced options as prices rise, and this will slow the increase of the tax brackets. It's designed to be a gradual tax increase. The old method of Consumer Pricing Index gave less weight to the shifting of purchasing behaviors due to the rising price of preferred goods and services. Economists have argued that normal consumer price indexing should not be used. Chained consumer price indexing reflects a slower pace of price gains or inflation than traditional consumer price indexing. The 12 months ending April 2018, the normal consumer price indexing was 2.5%. The 12 months ending in April 2018, chained CPI was 2.3%. A slower rate of inflation on the tax brackets will mitigate the lowering of the tax brackets over time. The major changes are, of the Tax Cuts and Jobs Act, the projected change in federal revenue over 10 years in billions of dollars. Let's take a look at this. Change CPI, the projected change in federal revenue is $151 billion. Now let's take a look at the changing tax rates. As far as the filing statuses go, there's still 5 filing statuses. There's no change to the current 5. Single, head of household, qualifying widow or widower, married filing jointly, and married filing separate. However, there is a new due diligence requirement for paid preparers when the client is claiming head of household. There's an expanded Form 8867, the preparer's due diligence checklist. Paid preparers whose clients are claiming the head of household are subject to audit and to a penalty for failing to meet this expanded due diligence. The penalty will be the same as what's imposed on a violation of due diligence for refundable credits. There are still 7 tax rate brackets. The tax rates under the TCJA are 10, 12, 22, 24, 32, 35, and 37%. The old rates were 10, 15, 25, 28, 33, 35, and 39.6. The 10% and 35% rate brackets previously existed. The rest are new lower rates. In general, the new tax rate structure means lower rates for most filers, with the top rate dropping from 39.6% to 37%. The ranges in most of the various tax brackets have been changed, but those changes are mostly modest. The 10% range for a single person in 2017 was from $0 to $9,325. The 10% range for a single person in 2018 is $0 to $9,525, an increase of $200. The 10% range for married filing joint was increased by $400. The exception is the 35% bracket. For a single and head of household person, the 35% tax bracket was $416,701 to $418,400. Now it's $200,000 to $500,000. The 35% bracket in 2017 for a married filing joint couple was $416,701 to $470,700. Now $400,000 to $600,000. Most single or head of household taxpayers in the 35% bracket will see an increase in their taxes. So, looking back, major changes are the changed CPI, Projected change in federal revenue, bringing in $151 billion. The new tax brackets and rates for individuals will lower the federal revenue by $1,589. And again, the source is the Tax Foundation. This is the largest single economic benefit that's contained in the Tax Cuts and Jobs Act. Next, let's look at the effects that the Tax Cuts and Jobs Act will have on personal exemptions on our tax returns. All personal exemptions have been reduced to zero for 2018. Under the pre-Tax Cuts and Jobs Act, each personal exemption was $4,050 in 2017 on our 2017 tax returns. The IRS had previously announced that the amount was to be adjusted to $4,150 for 2018 before the Tax Cuts and Jobs Act was passed. There is no change in the definitions of a qualifying child or a qualifying relative. A qualifying child, or the definition of a qualifying child, is relevant for the new child tax credit, head of household status, and education credits. The definition of a qualifying relative is still relevant for the new child tax credit. So, the elimination of the deduction for personal exemptions will have a positive effect on federal revenue, $1,227 billion. Next, let's look at the standard deduction. For 2017, the standard deduction for a single person was $6,350. For 2018, it will be $12,000. Looking down the column, for 2017, head of household was $9,350. For 2018 tax return, head of household standard deduction will be $18,000. Married filing separately for 2017, $6,350. Married filing separately for 2018, $12,000. Married filing jointly, $12,700 for 2017 and $24,000 for 2018. Qualifying widow or widower, $12,700 for 2017 and $24,000 for 2018. So you can see that the standard deduction, even though you'll hear in the news broadcasts that the standard deduction doubled, almost doubled, but not quite. There's been no change to the additional standard deduction for a taxpayer who's 65 or older and for a blind taxpayer. In 2017, the additional standard deduction amount was $1,550 for single and head of household and $1,250 for married filing joint, married filing separate, and qualifying widow or widower. In 2018, the additional standard deduction amount is $1,600 for single and head of household and $1,300 for married filing joint, separate, and qualifying widow or widower. So a $50 change in those amounts for 2018. The increased standard deduction will have a somewhat negative effect, $774 billion in federal revenue over 10 years. The last topic of Part 1 of the Tax Cuts and Jobs Act and its effect on individual tax returns is itemized deductions. Historically, approximately 3 out of 10 taxpayers itemize deductions, typically 31 to 33%. Residents of certain states are more likely to itemize than residents of other states. These are influenced by the state and local income taxes and property taxes. Higher income taxpayers are more likely to itemize because they may have larger mortgage interest deductions or larger, in dollar terms, charitable contributions. States with the highest percentage of taxpayers who itemize on their tax returns are number 10, New York, California, Minnesota, Massachusetts, Utah, Oregon, Virginia, and the top 3 are New Jersey, Connecticut, and the number 1 state with the highest percentage of taxpayers who itemize, Maryland. States with the lowest percentage run from West Virginia, South Dakota, North Dakota, New Hampshire, Florida, Texas, Nevada, Wyoming, Tennessee, and rounding out the top 10, Oklahoma. Georgia is above the national average, 6% of Georgia residents itemized. We're ranked 13th. South Carolina, our border state, is close to the national average. 30% of taxpayers itemize, and South Carolina is ranked 25th on the list. Here's a map of the percentages of residents who claim itemized deductions in 2014. And the source is the Internal Revenue Service 2014 individual income and tax data. Tax Cuts and Jobs Act restricts and/or eliminates many itemized deductions that were previously available to taxpayers. Most projections are approximately 1 out of 10 taxpayers will itemize deductions in 2018 as opposed to the normal 30%. In other words, 2/3 of taxpayers who itemize in 2017 will instead use the standard deduction for 2018. This could have a significant impact economically on tax preparers with fee structures based on doing Schedule A. And just as a refresher, let's take a look at the 2017 Schedule A, the itemized deductions. They include medical and dental expenses, taxes paid, state and local income taxes, real estate taxes, personal property taxes such as ad valorem tax on car tags, interest paid, home mortgage interest, points, mortgage insurance premiums, investment interest, gifts to charity, gifts by cash or check or other donations, casualty and theft losses, job expenses, and certain miscellaneous deductions, and then other miscellaneous deductions, creating total itemized deductions. In the case of medical expenses, for a 2-year period, 2017 and 2018, the medical expense deduction will be subject to an adjusted gross income threshold of 7.5%. This is the only item that was made retroactive back to the beginning of 2017. And if you recall, the adjusted gross income threshold was increased to 10% as a result of the Affordable Care Act. Starting in 2019, the deduction for medical expenses will revert back to that 10% adjusted gross income threshold, which it would have been under pre-TCJA conditions. In 2017, taxpayers could deduct as mortgage interest on combined mortgages up to $1 million or $500,000 if married filing separate. The mortgage could be on primary and one secondary home. Home equity interest on loans up to $100,000 was deductible, and mortgage insurance premiums were deductible as a result of the Bipartisan Budget Act of 2018. Beginning in 2018, taxpayers can deduct the following as mortgage interest. Interest only on the primary and secondary home, and it's limited for any mortgage obtained after December 15, 2017 to a mortgage of $750,000 or $375,000 if married filing separate. Mortgages on the primary and second home obtained prior to December 15, 2017 are subject to the previous $1 million limitation, and any contract to purchase a primary residence that was entered into prior to December 15, 2017 and closed by April 1, 2018, that mortgage will be subject to the $1 million limitation. As far as refinancing on a mortgage interest from a refinancing after January 1, 2018 qualifies if it meets the following. It's no greater than the original purchase price of the primary home, secured by the primary or secondary home, and is no more than $750,000, and meets one of the following: does not exceed the amount of indebtedness being refinanced, or if it exceeds the indebtedness being refinanced, the proceeds are being used to, quote, substantially improve the home. Home equity interest is deductible only if it meets the following conditions. The limit of $100,000 no longer exists, but is subject to the overall limit of $750,000. The home equity loan cannot exceed the cost of the primary or secondary residence that secures the debt. And the proceeds of the home equity loan must be used to substantially improve the primary or secondary home. Beginning in 2018, taxpayers cannot deduct the mortgage insurance premium, or PMI. The PMI deduction was extended for 2017 tax year as a result of the Bipartisan Budget Act of 2018, and most of the tax extenders in the Bipartisan Budget Act were only for 2017. Taking a look at state and local income tax deductions. In 2017, taxpayers could deduct all state and local income or sales taxes, all local property taxes, and all local personal taxes, including ad valorem taxes. In 2018, all deductions for state and local taxes are limited based on the filing status. For married filing joint, a limit of $10,000. All other filing statuses, $5,000. As far as the Tax Cuts and Jobs Act effect on charitable deductions, for many years there have been certain limits imposed on the amount that can be claimed as charitable contributions. 50% of adjusted gross income was the maximum donation to qualified charitable organizations. 30% of adjusted gross income was the maximum donation of appreciated assets to qualified organizations. 30% of AGI was the maximum donation to non-qualified organizations, and 20% of AGI was the maximum donation of appreciated assets to non-qualified organizations. Any charitable donation in excess of the AGI limits could have been carried over for up to 5 years or 15 years in the case of qualified conservation contributions. The carryover charitable deductions had to be used before the taxpayer could take any current year deduction for charitable deductions. Beginning in 2018, the 50% AGI limitation on deductions has been increased to 60%. The carryover deductions can now be up to 60% of the current year adjusted gross income. The 5-year period to carry over charitable deductions remains, and other changes affecting charitable deductions include college athletic seating rights are no longer considered a charitable deduction. Let's take a look at casualty and theft losses and what will be the changes for 2018. Previously, all personal casualty losses not subject to the special provisions enacted in 2017 for hurricane losses and other federal disaster designations were deductible subject to the following. It was a $100 deductible, and then the loss after the deductible had to be in excess of 10% of adjusted gross income. Starting in 2018, non-federally declared disasters that result in personal casualty losses are no longer deductible. Going forward, only personal casualty losses in federally declared disaster areas are allowed. Disaster-related personal casualty loss shall be subject to the following: a $500 deductible. There's no AGI limitation, and the net personal casualty loss can be included on Schedule A or added to the standard deduction if it's more favorable to the taxpayer. Business casualty losses, unlike personal losses, are not subject to any deductible. 3 types of business casualty losses are employee property, income-producing property, trade, business, rental, or royalty property. When the property was disposed of, and it was income-producing property or trade, business, rental, or royalty property, then the casualty loss could be carried to Form 4797. Otherwise, the loss could be claimed on Schedule A as a miscellaneous deduction. Now let's take a look at the 2% miscellaneous deductions and how they will change because of the Tax Cuts and Jobs Act. This entire section of Schedule A was eliminated and will no longer be in the tax program. Things like tax return preparation, safe deposit rental, job search expenses, uniforms, the 2% miscellaneous deductions will no longer be available. However, some miscellaneous deductions will remain. Many business casualty losses, repayment of Social Security benefits when less than $3,000, pass-through deductions from Schedule K-1s, Gambling losses are still limited to the amount of the winnings. Claim, starting in 2018, more inclusive definition of gambling loss will occur. It now includes other costs associated with gambling, such as travel costs to and from a gambling location or casino. Under prior law, there was an overall limitation on itemized deductions. Under prior year's tax laws, the amount that higher income taxpayers could itemize was limited by 3% of the amount when 80% of their income exceeded certain thresholds. This limitation has been eliminated. Again, let's refer back to our Schedule A Pre-Tax Cuts and Jobs Act. 7.5% of the adjusted gross income threshold will occur for medical and dental expenses in 2018. SALT deductions are limited to $10,000, state and local tax deductions. Mortgage interest limited to a mortgage of up to $750,000 on a primary residence. There's a 50% AGI limitation that previously existed for charitable donations. It's been increased to 60%. Personal casualty losses will only be allowed in the case of a federally declared disaster. All miscellaneous deductions, subject to the 2% of AGI limitation, are eliminated. The overall limitation on itemized deductions has been eliminated. So, looking back at all the major changes that have occurred, the changes to itemized deductions will have a projected positive change in federal revenue of $575 billion over 10 years. Now, this concludes Part 1 of the Tax Cuts and Jobs Act and its effects on individual tax returns. We'll pick it up again in Part 2 with above-the-line deductions.